Hello, everyone. Welcome back to our financial video series here with QX Financial. So today we want to finish our discussion that we started 3 weeks ago regarding the which one's better, whole life or IUL. If you guys remember, we have this video that we've been sharing with you the last two videos about this gentleman that makes some claims about why IUL is better than whole life and in the context of retirement income and making other claims like that. So we spent quite a while showing you why some of those things may or may not be correct and trying to inform you guys and help you make a better decision when it comes to the type of policy that you want to use. So what we want to finish the series today, and we want to focus on his last claim, which is about retirement income. And overall, his point is that IUL will always be better and is better providing retirement income than whole life. And we're going to address that point as we go through this conversation with the team today. But we want to start with you today talking about why isn't even a thing to take retirement income from life insurance. So we're going to explore that point today. So I want to thank my team, Terrell, Scoba, Sonia, for joining me today as we have the last couple of weeks. So thank you for being here. But let me start with you, Sonia, because we know that life insurance provide a lot of tax benefits when used appropriately. So can you tell us more about what are the tax benefits of using life insurance in general for retirement income purposes?
Well, some of the standout features of a whole life policy is that there is no income tax, there is no capital gains tax, and unlike a qualified retirement plan, there are no age 59 and a half rules, and there are no early withdrawal penalties. And in terms of like the age 72 rules, you don't need to worry about that with whole life. And another positive is that it does not trigger any taxes on your Social Security payments.
So it sounds like you get more flexibility.
Exactly. So flexibility is key. And I know that in the coming years, taxes will be at the forefront of everyone's planning.
Exactly right. And do you mind telling the viewers, because I think it's also important, people don't realize that if they make too much money, quote unquote, they'll have to pay tax on the Social Security.
It's exactly right. And, you know, in the change, with any changes with the tax brackets, that could spell disaster for someone's retirement planning.
Exactly right. Yeah. So taxes is definitely one of the biggest advantage, or the lack of, right, having to that income qualify for as income taxes is one of the for income taxes is one of the biggest advantages of the life insurance cash flow strategy. But there's another side of it, so something that we call opportunity cost. There is another benefit of also taking cash flow distributions from an insurance model. So, Terrell, do you mind telling us a little bit more about what opportunity cost means? How does that come into play with life insurance, and what is the advantage of using that as a source for retirement income?
Of course, thank you, Jenko. Opportunity cost is probably my favorite concept when it comes to this being your own banker ideology. And whether IUL, mutual funds, whatever you're talking about, when you break down opportunity costs, nothing else can compare or come close to this. And most people don't even understand what it is because we've been taught something else since birth. So the idea that we can put our money away in this account, it can grow exponentially without interruption, but I can access theoretically some of my money through a policy loan. Thus, it's not interrupting my growth. So my money is going to keep growing. Unlike your mutual fund, your house, these things can all keep growing, but can you access money? Can you pull the money out and it still keep growing? And the simple fact is you can't in any other financial vehicle. So the fact that we can come with a guarantee, two, you have that exponential growth happening without being interrupted, while also getting access to some of your cash is very important. A big thing for us here, being with a mutual company, is something we call non-direct recognition. This is a big word they use that says, in essence, when the company charges you an interest, like anybody does when you borrow some money, if you pay this money back, it's going to go back into your pocket. So now, once again, you can borrow money from yourself without interrupting the growth of your cash growth exponentially, right? And at the same time, when you pay back the interest, it goes back to your account. So you never lose money. You just have an opportunity to make more money. And a lot of companies don't offer that.
Exactly right. And with that kind of piggybacking on what you're saying is the whole idea of retirement is not about assets, it's about income, right? And we've discussed many times before, and some of you guys viewers can find the video in our video library. We've talked about how mutual funds are ill-equipped to become income, because what Terrell is saying is true. You have to give up that share to be able to convert it into cash. And by giving up that share, you're giving up all the future equity, which is something you don't have to do when you use non-direct recognition, right?
Correct.
Yeah, and that's probably one of the most important features there. So we have taxes, we have opportunity cost gap that you can close using life insurance as a strategy. But there's another one, and people always talk about this all the time, about performance. But what about the performance? Is my policy really going to be competitive versus what's out there in the market or any other investment opportunities? So Escobar, tell us more about that. Is IUL really going to perform much better than whole life? And because that seems to be the argument that this gentleman that we're talking about today about his video, that seems to be the argument that he's making.
Absolutely. And I have no argument with the statement that an IUL can perform better. The question is, will it perform better? And no one can possibly answer that question 5, 6, 10 years from now. If you look back at the entire history of the stock market, there have been highs and lows. There have been bull markets and there have been bear markets. It goes up and down. Maybe over time, it's definitely kept going up. But now we're starting to talk about income, or from the company standpoint, distribution. Mm-hmm. Now, if you take your distributions during a bull or an up market, well, all is well. But if you have to take distributions when the market is going down, you will lose more money than just what you're taking out. And if there are 3, possibly 4 down markets in a row, well, you still have to take your income. You might find yourself with much less money in an IUL than you have in a whole life. Whole life, by its very nature, is not attached to the stock market. If you are illustrated 25 years of income at a certain amount, that's what you're going to get, regardless of what's going on externally in the markets or inflation or whatever. An IUL cannot provide that same promise.
Exactly right. And to be fair, for those of you that are watching about IULs, hey, but I thought IUL had a guarantee. Yeah, you have a 0% guarantee, no question about that. But the point that Escobar is making is, what happened during those years that I make 0? I'm going to be forced to adjust my income. Because again, when you look at a IUL illustration, it usually shows 6% compounded every year or 5%, and some of the very responsible agents are going to show you 9, 10, 12% per year. Those are not realistic numbers, but they almost never going to show you a 0, right?
Right.
So what happens?
And I was going to say, one major reality few people think about is you're taking this money during your retirement, which means you're going to be 68, 70, 72 years old. That means you're going to have to adjust your income at an age and a time in your life when you can least afford to do so.
Exactly right.
So that is something to think about.
Exactly. And one last point on this, don't forget, the caps are not guaranteed. The participation rates on the IUL are also not guaranteed. Again, we're not saying IUL is bad, but just to make that claim, just, hey, this is better just because it it's not an objective conversation. I agree. Now, last point on this, in the context of whole life, Yeah, dividends go up or go down, but if you look at them historically, there's always a dividend. Maybe a little more, maybe a little bit less, but there's always a dividend that provides a much more stability, especially when you're retired now, you're taking that income. Exactly right. So let me close the video today. Last point on the policy loans, because not all policy loans are created the same. That's another point that he forgets to bring up. Different products, different companies offer different kinds of loans. So all the loans are not going to work the same way. The standard loans, index loans, you have preferred loans on whole life, and then every company has different tags that they put to those. Also, you can make withdrawals. You don't even have to take loans. How does that affect your policy? So there's all these different things that you don't have to decide right now if you're in the accumulation years, right? But you need to know what's available in your policy so you have an idea what is the best way to get that cash flow, that distribution income coming your way once the moment is right. Obviously, we cannot cover every single different company today, but that we're going to encourage you guys to reach out to us at QX Financial. You should be seeing our information running at the bottom right now. Any questions, any concerns, there's nothing for us to charge you for or, take your money. Our goal is really to educate you, give you some options, understand the perks that you own much better. And if you haven't really looked at the insurance strategy, let us know too. We're happy to show you how you can set some of this up for your own benefit, short term and also long term. So I wanna thank the team once again. Sonia, Terrell, Scoba, thank you for helping us with this video series. All the information is down below in the description. Do not forget to subscribe. And once again, any questions, please let us know. Thank you, guys.
Thank you.
Okay, thank you.
Bye-bye.